I think we're in for quite a ride here. Buckle your seatbelts because this is going to be history in the making in the next 3 to 6 months, I believe.
This week's specials with Miles Franklin Precious Metal Investments. 2022 Gold Britannias for only $79 over spot, and 2022 Silver Britannias for only $369 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is David Hunter, a contrarian macro strategist with more than 40 years on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah, great to see you again.
Great to see you as well. And you've been calling for a while, the largest global financial crisis in history. You've talked about how you see a really blow-off top in the stock market before up to an 80% crash. Now, you've recently revised your forecast for the stock market, and you think it's even going higher. So can we get an update on your expectations for the stock market, and also why you see a significant crash coming in the near future?
Sure. My most recent quarterly letter, I raised my targets on two of the indexes, the Dow and the S&P. So I had been at 5,000 on the S&P. I'm now looking for 5,300. Dow, I was at 40,000. I'm now looking for 42,000. So significant upside from where I had already been high on the street, I think. And those targets had been only raised back in early July. So very unusual for me to change targets that quickly, but that's the nature of the market we're in. And my analysis just said this thing has legs and it's going to go a lot further than I originally thought. So, I've raised targets along the way because this thing has been powerful. And I actually, in looking at it, think I'm probably not even there yet. This thing could really, in terms of, you mentioned blow off, it could really be quite a blow off top. And who knows? I mean, 5,500 on the S&P, and maybe I used to laugh at people who talked about 6,000, but maybe we're going there. And the only reason I say that is because when I step back and look at the pause we had, really in starting last spring, the industrials kind of topped out in the spring, and some of the FANG stocks, some of the growth stocks started picking up then, and they kind of carried through the summer, so it kept the market from really any kind of big sell-off. They kind of worked their way higher, but it was choppy. But the industrials really have been, in a consolidation for 6 months. And now you're seeing, at least my work is showing, that those consolidations are coming to an end and that the industrials are starting to pick up speed again. And I think we got a whole leg ahead of us in that, which means the materials, the industrial stocks, a lot of those areas, the semiconductors, et cetera. I think things that are dependent on the economy, we had what I call a pause that refreshes this summer. It's gotten so many people bearish, thinking, oh, the economy is topping out, the momentum is reversing, and everybody's worried about the end of this cycle. So that just got them thinking, we've seen it. We've seen the momentum in the economy. We've seen the momentum in the stock market. We've seen the top in the market that's going down. I couldn't disagree more. I mean, I think we are setting up here for another big leg. 5,300 from here is probably 20%. So that's a big move to happen, let's say, in the next 3 to 6 months. But if it's going even further than that, it's a hell of a move, unprecedented move, and would fit in with what I've called for most of this post-March swoon of, March 2020. I've talked about a melt-up ending this cycle for a long time. That's what I think we're going to see is a true melt-up where investors get very euphoric. They start saying, oh, this cycle has a long ways to go, and they feel more comfortable getting in. So it's hard for people to imagine because they're all with one foot out the door looking for the exit. it's hard for them to imagine that this thing really could just be, they could be totally 180 degrees wrong and have to reverse themselves, and actually their mindset will change to where they think this thing's got legs. So that's where I'm at. It's not where I expected to be at this point. I thought we'd probably see the top, by the end of this year, certainly, maybe even sooner. But if the work says it's not here yet, I just revise my targets and keep going, and that's kind of what I see. The other side of it, the other side of the mountain, is I think a very unprecedented historic bust, and I use bust to describe something that is almost depression-like, but happens at the speed of a recession. So it will be a true severe downturn in both the economy globally and the stock market globally. So as you said, I think we could see a peak to trough decline of 80%. Now, 80% from 5,000 is 1,000. 80% from 6,000 is, a couple hundred points higher than that. So, I don't know the precise level we're going to, and it doesn't have to be 80. It could be 70. It could be 85. But that's just a ballpark of what I think the magnitude of the decline would be. And it's basically something that will be the biggest decline since the 29 crash, will be certainly the biggest decline in the post-World War II era. We saw a 60+% decline in 2008-9. So, it gives you some framework. This will be, bigger than that, probably happen at least that fast and maybe faster. As to why, I think a bust happens. A lot of it is the leverage in the system. We've got 250 trillion plus in debt across the globe. We've got quadrillions in notional value of derivatives across the globe. That's leverage like we have never, ever in the history of mankind had before. And when something happens, typically a policy mistake happens, that leverage just means things get whipped around a lot more severely, a lot quicker than happens if you don't have that kind of massive leverage. And it leads to a lot of actions and reactions. And as a result, I think, you're going to have something we haven't seen in your lifetime, certainly, and in mine either. So, there's some pretty exciting things ahead on the upside, but people need to understand that that's going to be short-lived, and then downside.
Now, with respect to what we're seeing in the stock market right now, and you mentioned how you're expecting a blow-off top that will just blow people away, right? Some analysts have been talking about how really for the last year or so, we have seen an increase in the stock market at a greater rate than we saw in the past. So that angle that the stock market is rising has been greater in the last year or so. Your perspective on that, and why do you not believe that is the blow off top and now we're starting to roll over?
Yeah, that's a great question. I probably used the term parabolic in association with what I saw coming well before anybody was thinking about it. So, certainly March of 2020, and I was talking about a parabolic ending this cycle even before that. Parabolic means it goes almost virtually vertically, goes almost vertical at its end. So what happens is the market kind of gains speed and the slope steepens as you move towards the end of the cycle, the end of the market cycle. And so if you step back and look at this on a 20, 30, 40-year basis, you look and it looks pretty darn vertical already. I mean, from a wide lens perspective, we're already in that parabolic. However, if you look at it more closely, in a shorter term perspective, the last 2 years, still pretty parabolic. As you narrow it down to say the last 6 months, what I'm calling for is, we've had in some respects, depending on the perspective, the length of your chart, we're already in the parabolic, but what I'm calling for is a last leg that will be the steepest yet. So, it's semantics, but I think it's going to steepen from here, and it can steepen from here. And that's one of the reasons why I say we'll cover the kind of ground that I'm talking about in a matter of months. Normally, that would be insanity. We're talking about, if it's 20%, that's a couple of years worth of market returns. If it goes to 6,000, from here, that's a lot more than, it's probably over 30%, 35%. I haven't done the math, but unprecedented. But when you get into that kind of euphoric last phase, and there'll be fundamentals to drive it. I mean, I think you're going to have some earnings situations, particularly in the industrial and basic materials area, that is going to help drive that. So what I would argue in terms of those that, as I said, have that one foot out the door, that think we may have already seen the top, basically I understand they see a slowdown, and they're thinking that's the beginning of a slowdown into a recession. And like I said, I think we're probably going to pick up speed again, reaccelerate, and allow for that last leg. And technically, it looks like it's beginning. Fundamentally, it's certainly I think we'll see in this earnings season, the companies have a lot of operating leverage, and it's showing in their earnings. And again, stock markets discount the future, so people have to be careful not to look at what's going on in this particular month fundamentally and think that associates with the price going forward. It's the market's looking out 3 to 6 months, maybe longer sometimes, and factoring in all the various factors to come to a bullish or bearish conclusion. And I think it's going to be a bullish conclusion.
Now, last time we had you on, you were talking about how really the valuations of gold and silver were really probably, there are few assets that can compare to the valuations of the metals right now. So really, it's an amazing buying opportunity in your perspective. Where are we right now? I know since we last talked, gold is pretty much flat, and silver is actually a little bit below. It was about 26 when we last talked, and now it's 22, 23. So your perspective on the valuations of the metals right now?
Sure. Yeah, I think we are in one of those periods where very few times do we see sentiment this bearish and valuations this good. It typically corresponds with a bottom. And of course, this isn't an all-time bottom of any kind, but it's a bottom after, I guess, a 14-month consolidation and a high-level consolidation. Been a fairly broad one, but still, compared to the move from March of 2020 to August of 2020, where we had big moves in gold and silver, this didn't go anywhere near back to the lows. So it's a high-level consolidation of which we'll exit it to the upside. And I think we're in the process of doing that now. So I see both gold and silver at very unusual and attractive levels. And certainly the miners fit right into that too. Their managements have gotten more religion about, being disciplined about running the companies. And as a result, you got probably the best cash flow pictures you've seen in those industries, perhaps ever, but certainly in many years. And so you got an unusual situation where you've got companies in good shape. You've got the metals at relatively historically high levels, but still having been through a 14-month consolidation, and what I think is a huge runway ahead. So I think the future of the next 6 months is very bright for the metals, and the future of the next probably 7 or 8 years is tremendously exciting in the metals. So it's amazing to me to hear all the negatives out there. And it's just a sign of how many people pay attention to the tape and the momentum of the tape rather than what's really going on fundamentally. It's investor psychology at work.
Now, you recently said you're expecting $50 silver and $2,500 gold. I believe you said in the next few months or the months ahead. So what is your time frame on those valuations?
Yeah, I would say, and timing always gets me in trouble when I try to pinpoint it. So people should not take this as some kind of pinpoint expectation. But I think certainly you could see those levels reached in the first quarter. Does it mean they have to reach in the first quarter? No, they could spill over. I think it'll certainly take more than 3 months. Could be less than 6 months is how I would put it. But markets, kind of find their own levels. That would be a heck of a move to see silver more than double in price and gold move up that much in even 6 months. And I think it can happen then. It doesn't have to happen that fast. Partly my timing is because I do think the stock market probably tops out, before gold and silver. And, I think this next leg, if it stretches, it can give gold and silver more runway. If we get to the top of the equity markets within the next 3 or 4 months, then, I don't think gold and silver that far behind that. It could still extend for a couple months, but not much more than that. So 3 to 6 month kind of time horizon for this move makes sense. I think it'll be well on its way by the end of the year, with lots more to go in the first quarter.
Now, with respect to how to play this as an investor, obviously we can't give personalized financial advice, but in your perspective, as we see the potential for precious metals to rise significantly, but also for this blow off top in the stock market to happen, how should investors be positioning themselves?
Yeah, that's a very individual situation. I'm not allowed to give any kind of guidance or advice. I can only forecast, as I say. So all I can say is probably the only thing I can say within that question is people need to understand that it's an unusual situation where you can cover a lot of ground in a short time. So that normally you would say, if we're just months away, whether that's 3 months, 6 months, 7 or 8 months, if we're months away from something that we haven't seen in 80 years in terms of downside, you're certainly cutting it pretty close, even now, to be taking that risk. But that's in a normal market. In a market where you could have 3 or 4 years worth of returns happen over less than 6 months' time before that downside, people have to kind of weigh those two things and figure it out for themselves in terms of how close they want to get, how cute they want to be. All I can say is I don't consider it all that cute to be owning stocks at 4,400 on the S&P if the S&P is going to go to 5,300 or 5,500 or even 6,000 before we go down. Here, because partly because I think people don't understand investor psychology or need to understand investor psychology, which is it's going to be very hard. Those that are bearish today are going to find it very much hard to resist being in the market 1,000 points higher on the S&P. It's just human nature is know yourself. Know that you're going to be more bearish at the bottom and more bullish at the top if you're a normal human being. I tend to be contrary to that and very comfortable being contrary to that, but most people are not. So human nature, what it is, investor psychology, what it is, people who are today so sure that they should be out of the market and bearish, when we're up 1,000 points from now, we're going to be the exact opposite. And I can speak with conviction on that because that's how psychology works, investor psychology works. So I can't say that about every individual because everybody's different. But as a group, most investors are going to be much more bullish, 1,000 points higher. If you can reverse that and understand that, so don't use today's perspective based on psychology to make your judgment about what's going to happen. Because if you do that, you're going to be out now miss a 1,000-point run and be getting in at the very wrong time. But that's kind of a broader perspective on how psychology works. From an individual perspective, people need to look at what makes them comfortable, what their capabilities are in terms of how nimble they can be, and know we're 39 years into a secular bull market that's probably going to be over before we get to 40 years. So that shows how close we're cutting this in terms of you're at the back end of the risk spectrum. You're nearing the end of a bull market, and a big bull market, a historic bull market. So you have to kind of weigh those two things: investor psychology versus kind of what that last leg may look like.
Now, I know in the past you have been forecasting inflation, and we've been seeing that about 5% inflation for the last couple months. Your perspective on where we are in that, if we're just going to continue to see that, because I know, Fed officials were originally saying it's just going to be transitory. Now it seems like it may be more permanent. So your perspective on where inflation has been for the last quarter and is heading in the future.
Sure. The Fed watches the index that's probably 4.5%, a little over 4%, and CPI is at 5, 2 or whatever. So, inflation right now, I guess you could argue, is between 4 and 5 on an official basis. I know a lot of people would take issue with that and say inflation's a lot higher than that if you look at housing prices and you look at your grocery prices, et cetera, but car prices. But overall inflation, looking at what they gauge inflation by, we're probably between 4 and 5%. I have said for several months, I expect inflation to accelerate from here. So we could, who knows what that means? Are we going to 6? Are we going to 7? Probably something in there, a higher single-digit number before the bust. And, Jay Powell talks about transitory, or certainly did for a long time, and got kind of mocked for it because we were watching, things that look pretty permanent in coming in. But he's right that a lot of this had to do with the pandemic and the opening up and inventory issues and supply chain issues. And once that gets resolved, which you could expect some of the prices to come back down. The problem is transitory doesn't mean the next 6 months. Transitory really could play out through the bust. And so I think the Fed's going to run into a situation where if we get up to 6 or 7% on the inflation numbers, they're not going to be able to argue transitory anymore. They're going to themselves doubt whether it's transitory or how much is transitory. And that means they're going to have to tighten. So that's been my forecast and my scenario for quite a while, is that this cycle will end when the Fed finally reaches that point of saying, we can't ignore this anymore. We've got to tighten, not just taper. We've got to tighten because inflation is starting to heat up so much that it's getting, it's broken out of Pandora's box and it's really starting to run. I think we're probably still a ways away from that in terms of maybe, another 1.5% on inflation or something like that, maybe 2%. But we're probably a few months away from that. But I think first quarter, for sure, you could see the economy starting to heat up and inflation heating up, certainly commodity prices heating up, and the Fed no longer being willing to, kind of hem and haw about tightening. I think we'll go beyond taper at some point sooner than anybody expects.
And one last thing before we let you go, if you could comment on interest rates as well. But you're expecting a short-term fall in rates, but then for them to rise in the near future, if you could expand on that.
Yeah, nominal rates obviously have risen of late, but because inflation's rising, the real rate, which has been negative, is actually getting more negative. So it's people focus on the nominal rate, say, well, rates are going up. That's not going to help metals. But it's real rates that matter because it's really inflation that matters to the metals. And so I expect real rates to stay very negative and get more negative because of that acceleration in inflation. But short term on nominal rates, I was probably a lone voice, a very lone voice, back when the 10-year was at 175, and I said we could go to 120. Well, we did that over 6 months, and then we quickly have gone from 120 back to 160. I think we're probably going to stair step our way up, which means we could easily see us go from 160 back to 135.40 on our way to 2.5, which is where I think 10-year rate is going, probably between now and the end of the first quarter. And again, inflation will be a big key to that. But so many people were bullish at 120. It's funny, they're bearish at 175. They all became bullish at 120 and said rates are going lower. And now at 160, they're all bearish again. So, again, looking at sentiment, looking at psychology, I would not be surprised to see a step down in rates here. Not all the way back to 120, but maybe 135.40. And I think that helps growth stocks. That helps. It will probably put an exclamation point behind lower rates for metals. But like I said, it's real rates there are already down, so that's not a big issue. But it just, more than anything, I think people need to be careful not to react to the tape when it comes to interest rates and get caught in, oh, gee, we've had a 25 basis point drop in rates, and they start then extrapolating that out into a 50 basis point drop in rates, because I do think the trend is up. There's no question the Fed's going to have to tighten at some point next year, and I think earlier next year, not later. And there's no question that inflation's accelerating upward. When I look at the commodity prices, there's no sign that those are rolling over. I think they are only going to pick up speed. So I'm calling for $6 copper. It went from $4.80 down to $4, and now is beginning to tick up again. I think you'll see $6 in copper first half of next year. Obviously, my gold and silver calls. I think steel's looking like you're going to see strong there. So it's going to be, inflation is going to be, I think, kind of center stage, and that will drive rates higher. The longer term story is that when we hit the bust, once we get to that 2.5, 10-year, probably 3% plus 30-year, I don't think there'll be a lot of upside from there, maybe a little bit. But once we have the bust hit, that will drive rates back down, and we could actually get the 10-year down to 0, and the 30-year maybe down to 0.5%. So it's not that we've seen the lows in rates for this cycle, but for at least the next 3 to 6 months, probably 6 months, rates are heading higher generally, except in a stair-step process.
All right. Well, David Hunter, thank you so much for your time today and all your insights. If people are interested in hearing more of your insights, they can go to your Twitter, I believe, and message you to get signed up for your newsletter.
I'm sure. Yeah, they can follow me on Twitter. I'm there most every day. So my Twitter handle is at Dave H. Contrarian. So at Dave H. Contrarian. And then if people are interested to have a quarterly letter, it's by subscription, so it's not free. But if people have interest in that, they can direct message me on Twitter, and I'll get right back to them with details of the letter.
All right. Any last thoughts you'd like to add, David?
No, just that I think we're in for quite a ride here. Buckle your seatbelts, because this is going to be history in the making in the next 3 to 6 months, I believe. All
right. We'll definitely be interested to continue to track this with you. David, once again, thank you so much for your time, and God bless.
Thanks a lot. Take care.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.